Hey everyone, welcome to another SMP Relatable. In a previous video, we talked about the retirement pyramid and that most Australians come time to retirement will end up on some form of pension. Now to help explain some of the reasons as to why this happens, we're going to go through a typical financial timeline. So from the time we're born through to the age of 20, we're usually heavily dependent on our parents. From the age of 20 to 30, we're just getting started, we're sorting our lives out, but hopefully we find that right job that pays enough money for allow us to purchase our first home. Now typically we'll take out a 30-year mortgage, and if it takes us 30 years to be able to pay that off, we've really only got a few years to be able to properly save towards our retirement. Now I use the words properly save because for most households I deal with, the mortgage will take up 50 to even up to 75% of their monthly income, which really only leaves them a small portion of money to be able to enjoy their lifestyles, but even less money to be able to put towards their retirement goals. What can be really scary is that if this is not your financial timeline and you're purchasing your first home at the age of 40 or even 50, you can imagine how that can actually push out when you can actually retire, or even more importantly, can you retire? What I'd really like to hear from you guys is, what do you think you can do to be able to chop this mortgage down in half? Because if we can do that, or even faster, we've got 20 plus years to be able to save for our retirement. If this has opened your eyes, or if you found it insightful, please hit the like button. Really want to hear your comments down below as to how you think you can pay this off faster. And remember, anything worth having in this life, we want to save, make, and protect.